Hey everyone, and thanks for jumping back into the Cryptoverse. Today, we're going to talk about Bitcoin and how it continues to struggle as good labor market data comes in. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. Let's go ahead and jump in. So, we've seen an interesting thing take place over the last week, and we sort of noticed it fairly early on, and that is essentially that good news in a sense has effectively become bad news. And the reason for that is as the labor market remains strong and the Fed having cut already 100 basis points, the bond market is essentially not playing ball, right? The yields long into the yield curve continues to go up. So what we're going to do is we'll talk a little bit about Bitcoin, but we're going to spend most of the video talking about the labor market and why Bitcoin is struggling right now. Now, before we get into all that, I will remind you, and I say this all the time, narrative follows price, not the other way around. No matter what the price does, we could come up with a narrative to support it. Okay, so you might hear me talk about certain things and be like, well, that makes sense. But again, you should remember that narrative follows price, not the other way around. And so while some of the arguments that I might say might sound very convincing, um, it's price that leads, not the narrative. Okay, so just remember that. But I'll still do the best job I can to at least make sense of what's going on in the market. The first thing to note with Bitcoin is that it's still doing more or less what it did last year around this time, right? And essentially what it is it went below the bull market support band in Q3, got a rally in October, November, same thing, same exact thing, and then it basically just went sideways for a couple of months, right? And what one of the things we mentioned before is that, you basically have these risk on and risk off times, right? You'll notice that last year there was also a wick higher in early to mid January, kind of like there was right here. The main difference between this one here in 2025 and in 2024 is that in 2025, it was a little bit weaker of a move because it did not lead to a new cycle high, right? This one over here did, this one did not, suggesting there's a little bit more weakness now. Now the price is a lot higher, right? But it's a little the trend is slightly weaker. Not necessarily a lot weaker. I mean, the overall move is still impressive, right? In both cases. But that is at least something to note, right? Kind of like how you can see the trend from 2023 was a little stronger than the one from 2024 in the sense that in 2023 we were able to even sweep these highs halfway, in the summer and basically hold these lows throughout that summer lull. But last year, it was a little bit different, right? It was this wedge where it was putting in lower highs and lower lows. And this was stronger than this. And then this area right there has been a little bit stronger than that. Now, one of the things to remember is that at the end of January in 2023, January 2024, Bitcoin eventually swept the range lows, right? So there were these lows that it was holding, eventually it swept it. More specifically, it actually held support on the 100-day moving average. Okay, if you look closely, you can see that Bitcoin wicked below the 100-day moving average and then it got a bounce back up. If you go over here today, we are still above the 100-day moving average, but where it is right now would actually correspond to this wick right there. Although you could argue that the range low that we're looking at compared to over here is more so this one at 90K, right? This one over here was at 40K. This one here is at 90K. So if you see Bitcoin sort of go below 90K, let's say it goes into the 80s, and you're looking to see if it's going to follow a similar pattern, then see if it finds support at the 100-day moving average. Now, it could be a few weeks from now. Remember, last year, Bitcoin didn't bounce until basically the last week of January. So if it's going to play out in a similar fashion, Bitcoin could still stay weak for another 1 to 2 weeks. before it potentially starts to pick back up. And that's, of course, if it's going to follow what it did last year. It could always do something different, right? It's always possible that it does something different. And it's important to remember that things will not always play out the exact same way, right? You could have deeper sell-offs, right? I mean, one of the interesting things is that Bitcoin, while it has felt weak, it actually has been a lot stronger than a lot of the other asset classes. If you remember, Bitcoin shot up a lot after the election, right? Right here. And at that time, it was at 67,000 or so. You guys remember that early November, 67K. It's still way up here at 93K. But if you were to take a look at the S&P 500, it's almost back to where it was in November at the election, right? In fact, the Russell has already given back all of the post-election result gains, right? If you were to look at the altcoin market, right? If you were to look at the altcoin market and go to November, you can see it's still way up here. So it kind of like raises the question, right? Does crypto have to make that same drop? Or is it just that crypto's holding up better? I think one of the things to remember is that it doesn't necessarily have to make the same drop. But if it doesn't make the same drop, that's one of the reasons why when bear markets do eventually come for the cryptoverse, they tend to be a lot worse than they are for the S&P 500, because they tend, it holds up, and then eventually you finally get a bear market, and then they get sold off a lot more. And there's also other comparisons to make with the altcoin market and the Russell 2000. One of those is that, basically after the altcoin market swept the high from last cycle, it hasn't really been able to continue just yet. In the same way, the Russell did the same exact thing, right? It also swept the high from last cycle and then has been struggling ever since. So again, you can see a lot of similarities. And one actually interesting comparison I like to make from time to time is to look at the altcoin market against the Russell, total 3 divided by the Russell, and see that it also swept the high, right? So there's so many interesting comparisons that you can make. But I digress. This video is supposed to be about Bitcoin and, of course, the labor market. So, look, I've always said, worst case scenario in the short term, right? I mean, long term, worst case scenario is different, right? But sort of, first of all, a realistic outcome, if it's just going to do what it did last year, would be it eventually sweeps this low below 90K, right? That could happen. If it happens, so be it. It might just correspond for the 100-day SMA sort of slowly coming up, going below that low, finding support at the 100-day moving average, and then waiting to see more data come in. That's one option. And then finding support and then bouncing off of there. That's sort of the optimistic scenario. Maybe sort of like a more middle of the road scenario could be that it could sweep that low, right? It's possible for it to sweep that low. Worst case, short-term scenario would be to sort of retest the breakout point, right? And again, I've mentioned that a few times. I don't necessarily think you should go into it, saying that that's the base case, because that is quite a big drop. But I do mention it just because the S&P has gone back down there. The Russell has gone back down there. So, I mean, it's always possible that you could retest this level that it took a while to break out from. And if it did go back down there, there'd probably be a pretty big bounce off of it. So that's just something to consider. And that would only be if things get really bad. But what's interesting is that if you look at the labor market, it's actually been relatively okay recently, right? Like the unemployment rate's at 4.1%. Let's just go through the data. So we're going to go over here to the Macroverse side of the website, and we're just going to go through a lot of the different things. We're going to start off with the unemployment rate. So the unemployment rate is at 4.1%. So it dropped back down. So all in all, that's a good thing. Now, a week or two ago, I would have said, and I did say, that a low unemployment rate is theoretically good for something like Bitcoin. But we sort of changed our tune on that earlier this week when we noticed that good labor market data was actually causing Bitcoin to sell off. Now, again, remember what I told you guys. What did I say at the beginning of the video? Narrative follows price. okay? We can always find a narrative, but you should know that Bitcoin historically gets corrections in January of post-halving years, right? A 30% correction in January of 2021 and a 30% correction in January of 2017. So it's somewhat foolish. And by the way, in January 2017, it found support at, you guessed it, the 100-day moving average. Over here, it didn't even make it to the 100-day moving average. But in 2021. But my point in this case is to say Bitcoin normally corrects in January of post-halving years. So why do we need to go find a narrative to support that outcome? Because we already knew that was a likely outcome, and now it's happening. And now we can come up with a reason for why it's happening. So just remember that. Don't get lost with the narratives. Focus on the price action, right? That's what makes the most amount of sense. I'm just trying to give you guys some basis for, why the market does what it does. If you see, MicroStrategy buying all this Bitcoin and you see these headlines for strategic reserves and whatnot, and you're wondering like, well, what's causing it? Perhaps it's related to that. But again, you can always find a reason. But the unemployment rate, 4.1%. So it came in low. But what we've noticed is that as the labor market data has come in good over the last week, it's actually led to sell-offs. So it's sort of like we've entered into this phase, at least in the short term, where good news is actually bad news. And the reason for that, right, the reason for good news now being bad news is because of the state of the long end of the yield curve, right? So if you were to go look at the long end of the yield curve, we're just going to pull up the 10-year yield. One of the things we've noted before is that whenever it breaks out, right, just like it did a little over a year ago, whenever it breaks out like this and then back tests the 21-week EMA like it did right here and right here after breaking out, right? You got a breakout and then a back test, breakout and then a back test. When that happens, the S&P 500 gets stuck in traffic on Struggle Street. And what you'll notice is that as the 10-year broke out and went higher, the S&P went lower. And the S&P did not bottom until the 10-year yield topped. You see? S&P bottomed when the 10-year yield topped. 10-year yield keeps going higher. Now, you can also overlay Bitcoin onto the same chart and see that Bitcoin, like the S&P, was stuck in traffic on Struggle Street during that same period when the long end yield curve is going up. Now, why is the long end of the yield curve going up? Well, it's a great question, and it really goes back to why is the Fed cutting? Okay, and I think that's the thing the market's asking itself right now. Why has the Fed cut 100 basis points when the labor market seems okay? And why has the Fed cut 100 basis points when inflation hasn't really gone to their target? If you look at inflation, in fact, over the last couple of months, it's starting to go back up. Now, it's still relatively low, all things considered. But if you go look at the 1970s, it started going up slowly. And then it really started to pick up in the post-election year in 1973. And the market actually topped out around that time and sold off. Okay? So the market is on edge, right? The market wants to know, is this what's happening? Because again, over here, the unemployment rate was actually going down, just like it went down today. And as the unemployment rate went down, inflation became an issue again. And so the market is essentially going back and forth between two extremes. And that is a weakening labor market or inflation reaccelerating. And it keeps weighing these two things. And this week, the labor market hasn't really looked that weak. It's actually looked pretty strong. And because of that, the long end of the yield curve has gone up. And it makes sense because the bond market is starting to say, well, hold on a second. What if in the short term, we should be more concerned about inflation continuing to just slowly go up. At this point, I think most people are just ignoring it. Just 2 data points, and hopefully it's a fluke. But what if we get another inflation data point and it's 2.9, right? And it just kind of keeps slowly going up. And then before you realize it, we get a month where it does something like this, right? Where it jumps from like 3.8 to 4.8 in a single month. That is what we want to avoid. We talked about this 2 years ago, how the Fed needs to stay higher for longer until they get the job done. If they cut too soon, it could lead to inflation re-accelerating. Now, to the Fed's credit, that is not obvious yet. You could argue that there does exist a Fed funds path that allows for a soft landing, right? You could argue that there have been soft landings in the past. There have been. Not a lot, but there have been. And so that is, I think, what's going on, right? The 10-year yield is skyrocketing because the Fed's cut 100 basis points, inflation's starting to go back up, and the unemployment rate's going down. So are they setting us up for, more growth than they want that then leads to higher inflation? One of the interesting things about this market is if you look at the S&P 500 divided by M2, divided by the money supply, one of the things that's really interesting, I've talked about this a few times before, but if you look at the S&P divided by M2, this is exactly the same area that the S&P got rejected from in 1998. And in 1998, the S&P sold off all the way back down here. Note that these lows right here, this low here in 2022 was the same low in December 2018, which was also the same low right here in July of 1996. And this high that the S&P has set in the short term is the same high that it set in August of 1998. What's even more fascinating is that back then, when the S&P 500 set that high, it actually preceded the Fed cutting rates from, believe it or not, 5.5%. Exactly where they have been, exactly where they peaked this past cycle. You see that? They cut rates from 5.5 to 4.75. And around that time, before that cut, the S&P 500 sold off. This time, the Fed's trying to get ahead of any major sell-offs, right? But you can see the S&P 500 sold off, and now it looks like it's starting to sell off again. But the point that I'm trying to make here is, look what happened to the Fed funds rate. That's what we don't want to happen. The Fed funds rate, let me change this to a different color so it stands out a little bit more. The Fed funds rate, after they cut, the following year, they had to start raising rates again. No one wants that, right? And I mean, even Powell has said they don't want that. But that is something to at least consider. And I think the market, whether they raise rates or not, I mean, that's not necessarily my base case. Whether they raise rates or not, though, the market at least has to ask the question, right? I don't imagine many people over here, after they started cutting rates, thought that, they were going to go from 5.5 down to 4.75. And then within a year or two, they were going to be back at 6. They were going to be up at 6.5%. Right? I don't think a lot of people were necessarily thinking that back then, but that's what happened. So whether it happens or not, the market is asking the question. And because the market's asking the question, the long end of the yield curve is going up. And as we saw previously, when the long end of the yield curve goes up, the S&P sells off. Bitcoin operates just as a risk asset like the S&P 500, whether we like it or not. And Bitcoin is doing the same thing. Okay, so the sell-off by Bitcoin is not Bitcoin specific. S&P selling off, Russell selling off. If anything, Bitcoin and even the altcoin market is actually holding up better than the S&P and the Russell up until this point, because the S&P and the Russell are basically back to where they were with the election result news. Bitcoin and the altcoin market are still well above it. So, I mean, maybe they go back down to it, but for now they're above it. So for now, they're holding up better than the S&P. If the S&P continues to go down, then you could see losses in crypto accelerate. But remember, last year, January, we saw the same sell-off into the 100-day SMA. And every January of every post-halving year, we've seen the same thing. Okay. The question is can it eventually go higher or not? The obvious answer to that is going to be dependent on inflation and the unemployment rate, right? Normally, you get right translated cycles where the peak is, um, the peak occurs after like a 3-year bull market, right? And here's like a good example of one, and then you just get a 1-year bear. Sometimes you get a 2-year bull and then a 2-year bear, where the top occurs in either December of the election year or January of the post-election year. That's not what we want, right? I mean, obviously that would not be good, but it's happened before. You have to wonder. You have to wonder. Again, I don't think it should be the base case. It pays more often than not to be more optimistic than pessimistic. But you at least have to think like the market, whether this happens or not, where you have a 2-year bull that's already behind us, whether that happens or not, the market has to at least ask the question: Are we going to see inflation reaccelerate, or are we going to see the unemployment rate go up? And that's why the market is struggling, because right now the long end of the yield curve is going up, and there's no clear indication as to when it's actually going to top. And as long as it goes up, risk assets are going to keep taking a hit, because as the long end goes up, it leads to sort of it can lead to compression of earnings, right? Which then leads to layoffs. Okay, it's all just and again, the business cycle takes years to play out. Hopefully, you've learned a lot as we've talked about it over the last few years, but just keep that in mind. You don't want to see unemployment rates skyrocket, and you don't want to see inflation skyrocket. It's hard to thread that needle, but that's what the Fed's trying to do. But if we get back on track, the unemployment rate is 4.1%. Okay, now let's go look at unemployment level by reason for unemployment. Job losers dropped. It dropped. New entrants to the labor force also dropped in terms of the unemployment rate. So that's a good thing. Re-entrants to the labor force also dropped. So for the most part, the data was pretty good. You guys remember when the Fed cut rates in September, and I said that the long end of the yield curve would likely rally into Q1 of 2025? Here we are, right? It's Q1 of 2025. Long end's rallying. I'm going to guess that the long end of the yield curve is going to top this quarter. That's my guess. The long end of the yield curve will top in Q1 of 2025. I could be wrong. Strong opinion loosely held. But that is my guess, is that the long end will top this quarter. I think it's going to go high enough to take the wind out of the sails for long enough to then lead to the 10-year yield going down, perhaps in like Q2, Q3. But I think it's going to top in Q1 of 2025. And if you want to know when, then good luck. I could see it topping around maybe the next FOMC. If not then perhaps the next one after that. But when is not that important of a question to me right now. Where is the better question? And what I would say is, if the 10-year yield sweeps that high, that would be good enough for me to flip bearish on that, on the 10-year, right? Bearish on yields. Because if you look at TLT, which is just like the inverse, right? What it normally does when it bottoms is it puts in a double bottom. Sometimes even a triple bottom, right? But you'll see that a lot of times where it might like sweep a low and then go up. So whenever that occurs, if and when that occurs, I would guess that's probably it for the long end. That's my guess, okay? Again, strong opinion, loosely held. I don't need any people being like, but you said, guys, I don't know, right? It's just dubious speculation. I don't have a crystal ball. If I did, I would probably keep it to myself, because, if you tell everyone, then maybe the market would do something else. But I don't have a crystal ball. I'm just guessing. I'm just saying, if you look at the 10-year, if you look at TLT, it tends to sort of do this thing where it double bottoms, and it's not even that far away from doing that. So if the 10-year yield were to rally to around 5%, that could be it for it. But in order for it to top, it needs a reason to top. And you're not getting a reason if you keep getting all this good labor market data. As long as the labor market data keeps coming in good, why does the 10-year need to top? Remember too that you could get an example where you get a sharp sell-off 1 week, making you think it's topped, and then it just keeps going higher. That actually happened in back over here, right? You had 1 week right here where it sold off a lot, and then the next week it just went right back up. So keep that in mind. And actually, it was around this level where it had a sell-off before then continuing to go higher. Now, if we go back to the unemployment rate stuff, we can go to the unemployment rate per state. Alabama unemployment rate actually went up. California stayed the same at 5.4%. Connecticut stayed the same at 3%. Idaho, 3 point. Does anyone watch this channel from Idaho? I'm curious. 3.7%. District of Columbia dropped 0.1%. I always like checking in with Florida. Florida went up a little bit. I want to check in with Texas. Went up 0.1%. And then also, let's check in with Virginia. It went up 0.1%. Number of states where the unemployment rate's going up over the last month. It actually increased by 6. So 6 more states saw the unemployment rate increase. Okay. Again, this is kind of lagging, so we need to update this data, but that's where it currently stands. Over the last 6 months, it looks like that. I need to get this updated though. I think it might need to get one more month of getting updated, because I think we might have just gotten the data not too long ago. So, but again, you can see it has the number of states where the unemployment rate's going up has continued to increase, but it's still not where it has been in prior major downturns in the economy. Here's a map if you're curious, and here's over 6 months. Alternative unemployment rate measures. Greater than 15 weeks unemployed. It dropped. That's a good thing to see. Job losers, U2, this also dropped. People not in the labor force, I'll let you look at it if you're curious. I also don't really think that some of these things are going to be as helpful. You can look at the labor force participation rate and see where it is, the civilian labor force level, the employment level. So this is the one of the ways to measure the employment level. And one of the things you can see here is that if you look at, and then this came in at 256,000, which is a lot. But one of the things to remember is if you look at where it previously came in prior Decembers, there were also some well, I guess there was a spike in January 2023, and there was a spike in December of 2023, right? And there's also a spike here in December of 2024. So oftentimes you'll see a spike around this time, but all in all, if you just look at a 3-month moving average, it has been dropping, right? It has been slowly dropping in terms of the establishment month-over-month survey. Okay. Now, if we go back to just sort of the normal thing and we look at the household survey, it went up by 478,000, which is a pretty big increase, all things considered. The year-over-year change actually went from negative to being positive again. Okay, so that's a good thing. The non-farm private payroll employment level, so I believe this is the ADP, yep. If we look at the year-over-year percentage change there, it's currently at 1.39%. Not that different from what we saw way back over here. Total temporary help services employees actually went up. Okay, so we haven't seen it go up that many times, but now you got 2 months in a row where it went up, so that's a good thing. It also topped out in March when the Fed started raising rates, and so far it bottomed 1 month after the Fed started to cut rates. Multiple job holders dropped by 109,000. Job postings on Indeed, this is total, so far has continued to slowly go up here, so that's a good thing. Employment to population ratio, year-over-year change is negative, right? But it isn't as negative as it was. Job openings went up. Again, it's been going up ever since the Fed started to cut. Job quits rate dropped So people aren't leaving their jobs. Layoffs are still low. They went up, but they're still low. Initial claims are at 201K. That's really low. My guess is they're going to start to bottom out soon. You can look at last year. You can see they bottomed out January 13th. This data point was for January 4th. So my guess is they're going to bottom out relatively soon. And as they start to go back up, that'll probably cause the 10-year yield to top out. Initial claims map. So this is basically just normalized by population. That's what it looks like. You can look at a continued claims map as well and see what that looks like. All in all, it still doesn't look that bad. And now hires are still down, right? Hires actually continue to drop. So I think the reason why, like if you look at this, you can see like normally the S&P follows hires, but this time it hasn't. Normally hires are dropping when the unemployment rate is going up because also layoffs are going up. This time layoffs haven't really been going up and hires have been dropping. And so what essentially is happening is companies are hoarding the workers, right? They're not laying them off that much, but they're also not really hiring new people. And so that's why I think you see this disconnect. Because, yeah, like the labor market isn't that great in the sense that it's hard to get a new job. But if you have a job, most of those people have been okay and they haven't been getting laid off. If we look at some of the indicators for recessions, you can look at the smooth recession probability indicator. As of November, it's 1.32% chance of being in a recession. If you look at the sum rule recession indicator, it is, it triggered a few months ago, but then it untriggered as the unemployment rate has come back down. If you look at the number of states where the SOM rule has triggered, it has, it's basically just done this. It went up, came back down, has gone up a little bit again, but still well below, the entire country. Here's a map of where the SOM rule has triggered, kind of just right in this central part of the country there across the middle. The real GDP recession indicator, relatively low. The coincident economic activity index, if you look at a year-over-year percentage change, still relatively high. And you can see where prior recessions have in fact started. And that's basically what I have for you, right? That's basically what I have for you. The only other thing I can think to really show is the job openings per unemployment level. So number of job openings per unemployed worker went back up to 1.14. So basically what it means, people are going to argue the data. You can argue all you want. But according to the data, there's 1.14 job openings for every unemployed worker. Okay? And this is right around the level that it was at pre-pandemic. It's a little bit lower, but right around that level. So labor market data has come in good the last month. And I think because of that, the bond market's like, well, enough is enough. You can't have it both ways, right? You can't have all these rate cuts without paying a price somewhere. And we're paying that price right now. We're seeing the long end go up. We're seeing the bond market revolt and say, how can they cut when the labor market looks okay? How can they cut when inflation has gone up the last couple of months? How can they cut until you actually see inflation durably going to 2%? You could make the argument that they've cut too soon. But again, the counterpoint is I think a lot of people say, well, why is the Fed cutting at all-time highs? The Fed, they're not going to wait for a market crash to cut, right? They want to get ahead of that. In 1998, they cut after the market dropped 20%, right? Remember that S&P divided by M2? They cut after that. This time, the S&P is getting rejected at the same spot against M2, but they cut before that rejection. So, it's a tough position to be in. But again, right now, that's at least the question that the market is going to ask. How can they cut when the labor market looks okay and inflation's starting to pick back up? Okay. And I think if you think about it like that, you can understand why Bitcoin is just kind of stuck in traffic on Struggle Street, right? The long end of the yield curve's going up. And so I think the question, right? The question really is, you could easily make the comparison to last January, but I almost wonder if the better comparison is to sort of this area right here. Because this area right here is where the long end really started to go up, right? If you look at the 10-year yield, and you overlay it, right? That's the move, right? Where Bitcoin struggled for a little while. Okay. And now we're getting a somewhat similar move right here. You can see last year, right? As the 10-year yield really started to go higher, that's where Bitcoin struggled. Okay. So my argument is this. As long as the 10-year goes up, right? As long as the data says labor's okay and the bigger problem is inflation and making sure it's not heading back up, then the 10-year yield will go up. As long as the 10-year goes up, risk assets, that will be a headwind. When the 10-year tops, it should be a tailwind for risk assets as long as it does not top on a really bad data point, right? If it just tops because initial claims are slowly starting to pick back up, that's a good thing for risk assets, more than likely. But if it tops because of a really bad data point, like inflation jumps a whole percentage point in 1 month, or let's say the unemployment rate jumps from like 4.2 or 4.1 all the way to 4.4 or 4.5 in a single month. If it tops on a bad data point, then you could see the 10-year yield go down and the S&P also go down. But if it tops on a okay data point where the trend just subtly changes, that's what becomes a tailwind for risk assets. So that's my interpretation of the market. Hope you guys enjoyed it. If you guys like the content, make sure you subscribe. I probably don't say it enough, but do subscribe. I think most of you guys are subscribed, honestly, according to the data. But again, please give the video a thumbs up. And if you guys want more of this stuff, check out the sale on ITC Premium at intothecryptoverse.com. We do 3 more videos each week for premium subscribers. One of those is AMA, an Ask Me Anything. And of course, you have access to the website as well. Thank you guys for tuning in, and I will see you guys next time. Bye.